was not significant either. When you go in and look at the data itself, though, that effect, that main effect for fees in terms of percentage versus absolute, is in the wrong direction as anticipated. So I think it's a trivial effect and the effect size is tiny, but what you see is a little bit of people being drawn to the more expensive fund if it's presented in dollars. So people could be using this is a conjecture, I mean it's a very weak effect, but using this cost as some sort of signal for quality. And that's exactly what we wouldn't want people to be doing here. So main takeaway points. So because of these very small p-values and tiny effect sizes, we conclude, based on our study, that this fee display of percentage versus dollars does not nudge decision makers to change their investment choices. And changing fees to dollars may actually alert participants to the cost, but they may be interpreting this information as a signal of quality, which we wouldn't want them to do, certainly wouldn't recommend. Bigger point is that fee format alone may not be strong enough of a stimuli to nudge decision makers to make different portfolio allocation choices. It may take something a lot stronger, perhaps even showing the cumulative effects of investing in too expensive funds over a course of 20 years. Everything we couched here was in terms of 1 year, and this would be one manipulation we're interested in looking at next. One point also to show is one way of representing these data that builds on points made previously in the previous panels, were the diversity of behavior and the sheer heterogeneity of different decision makers in this task. I've shown you very standard analyses from the behavioral sciences, but these averages often hide the amount of variance that goes on behind the scenes. So let me just show you one way of representing how people make these portfolio choices. Each dot on this in this plot is going to be a person's portfolio. The x-axis is what proportion of their budget they put in the cheapest ETF. The y-axis is what proportion they put in the most expensive. So if people were investing all in the cheapest ETFs, they'd be down in this corner. Naive diversification would be at 0.3 and 0.3 on the x and y axis, all right? And we can imagine other sorts of strategies that may be followed here and where we would start to see the mass of people investing. Any conjectures as to what people do? So this, just in the interest of time, I won't make you sit and think, but each one of those dots represents a person's choice. And so the red dot in the middle is the average of all of this, but there's a tremendous amount of variability in what people are doing. Some people are investing all in the cheapest ETF, are sensitive to price. Others are naively diversifying. Others are using strategy like 60-20-20. It's all over the place. So I think that when we do these experiments, it's worth being able to tease out the data, not only to find out what people typically do, but start to think about results in terms of the diversity and the heterogeneity of people's preferences and the strategies they bring to bear on these problems. Okay. Thank you very much for your attention. I'll be around later and be able to talk to you one-on-one, and I look forward to the discussion that commences hence.
Good afternoon. My name is Tom Smythe. I teach at a small school in South Carolina, Furman University. One of the things that probably brings me here is the interdisciplinary nature of the topic itself. Most of my work has been on the advertising side as opposed to pure regulatory disclosure. But we achieve and get to some of the exact same points that Professor Taha has already brought to bear. One of the things that really got me interested in this area was a new rule proposed by FINRA back in, or what is now FINRA, back in 2007, that when a fund is going to advertise performance, that they also present cost information, very specifically in the form of expense ratios. And a psychology colleague of mine, Beth Pontari at Furman, and I said, you know, that's great. The question is, will people actually use the information in what we believe was its intended sense, which is to make better informed decisions, not look at performance, things of that nature. So not being a psychologist, the whole idea of an experiment was foreign to me, being predominantly a finance guy, but it certainly seemed to make a lot of sense to bring to bear these other fields in trying to understand what we knew, and as economists, was a more optimal choice, and that is typically lower cost funds. So what we did is we created a set of advertisements where we varied three pieces of information: brand, returns, and cost in the form of expense ratios. Under the FINRA rule, as Professor Taha pointed out, there are very specific guidelines as to font size, where the cost information had to be presented in the context of the ad to make it as equally prominent, things of that nature. We were hoping that what we would find is that, in fact, people would use this cost information in very economically rational ways. In other words, take low cost into account, put high cost at the bottom in terms of rankings, and hopefully, if we were really lucky, for them to ignore performance, because as we've talked about already all day today, the closest thing that we probably have to a physical law in finance is that mutual fund performance does not persist. Yet, even with disclosures, we had the standard disclosures in the ads, what we found is just the opposite. In fact, investors either did not understand cost as presented or completely ignored it. In fact, what we found is that when only cost information is provided, so we did not even in the ad present performance, those 6 ads were ranked at the very bottom. Even poorly performing funds, we had 2 different performance metrics, those advertisements were ranked higher. So there's clearly this attraction to performance independent of the salience of the other pieces of information that are in the ad. We did a couple of other things that me as a finance person wouldn't have even considered, and that is we asked some pre-experimental questions and then some post-experimental questions. We asked the people, the participants, what information would you like to see in an ad prior to presenting them with these ads? Unfortunately, the #1 response was performance. The second was cost, and the third was risk. We did not address risk in this study. Then after they were presented the ads, we asked them, what do you remember seeing? Prior to the experiment, about 25 of the 35 said they would like to see costs. Post-experiment, only 10 remembered seeing cost information at all. So one conclusion is either they just ignore the information altogether, or in prior survey evidence, we would tend to believe they probably don't completely understand things like expense ratios, all right? In a subsequent study with a marketing colleague, Bob Underwood, and Dr. Pontari at Furman, we also looked at advertisements from a content perspective over the 10-year period from 2000 to 2009, where we were specifically looking at things like what types of differences do fund companies, how do they change their ads across different market environments. So the 2000 to 2009 period, we had both an up market and a down market. As Professor Taha points out, in up markets, performance is huge. That becomes about 45% of all print advertisements have some kind of performance metric. And as he points out, those funds have done exceptionally well in the past, but are very likely to underperform going forward. But one of the things that we looked at is, have we been identifying cost far too narrowly? In other words, as academics, we tend to think in numbers. And in my field, it's all about the expense ratio. But we said, what if funds are trying to convey cost information in more qualitative ways as opposed to expense ratios? Might in fact we be seeing more incidents of advertising costs than we may have given the industry credit for? And in fact, we found that the overwhelming trend from 2000 to 2009 was in fact that costs were being advertised more, but in non-quantitative ways. The next logical question to ask is, well, if those that are advertising cost, are they truly cost effective? In other words, do they actually have lower expense ratios? And preliminary evidence would suggest, in fact, they do. So what does that mean? First and foremost, what we're here to talk about, I think, is absolutely critical. And that is, we need to test before things happen whether or not, in fact, it's going to work. The conclusion from our study of advertisements is that, in fact, adding the cost measure probably didn't achieve its intended goal. Okay? I think the other thing is, especially in my field in finance, we probably need to think about things somewhat more broadly than we have in the past, whether it be numerical or otherwise, and try to determine if there are better and alternative ways to achieve the same type of outcomes. Thank you.
Okay, well, this is, I think, the last talk in the conference. So let me take advantage of that and say that this is one of the most interesting one-day conferences I think I've ever attended. The quality of talks has been so exceptional. I want to congratulate the organizers for putting together an amazing day. So.
I just want to mention Frankie White, who's in the front, who has done a lot of the logistical stuff as well. So.
And I also wanted to take advantage of this being the last talk to change gears a little bit. So this is the Positier. I'm really tempted to give it a French pronunciation, but America first. Yeah, but it's the Positier Evidence Summit. And so I wanted to talk just a little bit about evidence and data and how we use it and things like that. And let me begin with a story. Maybe like a decade ago, I started working with a guy named Kevin Volpe at University of Pennsylvania. We started doing various health-related studies together. And I met him at a conference. The first study we ran together was something looking at a drug called warfarin, which you might know has another purpose. Warfarin is a blood thinner. And if you've had a stroke and you take warfarin religiously, you can reduce your chance of your likelihood of having another stroke in the next year is about 15%. If you take warfarin religiously, you can reduce it down to about 2%. So it's really a wonder drug. Now you might know what the other use of warfarin is. The other use is it's rat poison. And the rats bring you make it sweet, the rats bring it back into their nest, they all eat it, and their blood thins, and they die of it. And the other consequence is doctors are afraid to prescribe it. And so it's estimated that a huge fraction of people who could benefit from warfarin don't end up getting it. So we devised a scheme involving lotteries and something called a regret lottery to get patients to take warfarin. And we went to the warfarin clinic run by Steve Kimmel at the University of Pennsylvania, and we ran 20 patients through our scheme, and their non-adherence rates went from something like 70% down to about 3%. It was like the most amazing thing ever. And money started raining down on us because drug adherence is such a big issue. And so we got a lot of money to run another trial, and this is a much bigger trial, and we were able to automate it much more. And lo and behold, the next trial was way less, it was much more disappointing. When we looked at people who had poorly controlled warfarin, to begin with, they did improve, but they didn't improve that much, and people who already were under control didn't benefit. But we still had momentum from our first study, and we ran a really big third study, and this third study really didn't work at all. This is kind of a cautionary tale, and this is the Positier Evidence Summit. Most of the summit is focused on it's focused on what we already know about investor disclosure, but we hear it's a summit to launch this new data collection initiative. So I thought it might be interesting to talk about some of the limits of kind of data collection. And we heard about investor testing from the acting chairman. We heard the expressions data-driven from the current commissioner, rooted in data and analysis. Again, from acting chairman POR, we heard evidence-based. So all these, like of course, we want to base policy on evidence, for sure. But if you look at the evidence-based medicine, that's like a really big deal in medicine, evidence-based medicine. The problem is no one can really agree what the evidence shows in medicine. So evidence-based medicine I would say it hasn't really taken off. Or if Milton Friedman in 1950 wrote a paper, The Methodology of Positive Economics, and arguing in favor of a data-driven approach. And he said that a lot of ideological conflict is really conflicts over data. It's conflicts over results, which are kind of masquerading as conflicts over values. And he said the perfect example is the debate over the minimum wage. It's a good thing to raise the minimum wage. And he said, well, this dispute, some people really advocate raising the minimum wage, some people don't. This dispute is going to be resolved by data. Well, it's, 65 years later, and all the people who are advocating a minimum wage keep running studies that find that raising the minimum wage is actually a good thing. All the people who are opposed to minimum wage keep running studies that find that minimum wage is the bad thing. So I want to raise the question of what can research tell us? What kind of research is most useful? I mean, clearly research is enormously valuable. If you look at a company like Amazon, Amazon is running experiments all the time, collecting data and fine-tuning its business model based on that. The task of the SEC is much more difficult. It's much more difficult to run policy experiments than it is to run Amazon experiments on customers. And so Brian, in your talk, you'd mentioned surveys, surveys are great for learning a lot, but surveys definitely do have some pitfalls. And for example, I've run a study where we ask people, which would you prefer? We show them a cactus, or would you like $3? And people say, I want the $3. But then we randomly ask people, another group, we randomly ask them, will you do this 10-minute experiment in exchange for $3? Will you do the 10-minute experiment in exchange for the cactus? A huge fraction of people say that they'll do it in exchange for the cactus, and a very small fraction will agree to do it in exchange for $3. But this other group, they're all saying that they prefer the $3 over the cactus. Take Bridget's study on looking at the effects of different types of disclosure on people's investment in different mutual funds. Well, we know that the big problem is that people don't they don't look at the information to begin with. And so even though your results from the study are very, very pessimistic, I don't think they're pessimistic enough, because in your study, you actually show them the information, and as good experimental subjects, they're looking at the information and trying to do something with it. So, but really the point is that we have to be very cautious about what we can learn about these types of experiments. Field experiments, like nowadays, field experiments are viewed as the gold standard. Like everybody wants to do field experiments. But a big problem is it's often difficult to do field experiments. And as a result, a lot of the field experiments that end up getting done are done with really easy things. Like if you look at the behavioral insights team in Britain, they do a lot of field experiments, but they're almost all like sending different mailings to different people, because that's easy to do, like changing policies or changing websites, things like that. Those, it's really difficult to have some people go to one website, some people go to another. So a lot of field experiments end up focusing on kind of the easy, things that are easy to do. Also, field experiments can be very misleading. Like the short run, often in field experiments you look at short run effects, but long run effects can be very different. If you think about something like the moving to opportunity field experiment, the short run where some families were encouraged to move to more affluent neighborhoods, in the short run, it actually seemed to show very negative effects, at least for boys who were transplanted into more affluent neighborhoods. In the long run, the people who grew up in the more affluent neighborhoods benefited. I think you can say the same thing about disclosures. Short-run effects of disclosures, like the disclosures new, people pay more attention to it. So on that, so disclosures might be likely to have big short-run effects. On the other hand, it takes people time to adapt to things, so the long-run effects might be bigger. In my view, when it comes to things like SEC disclosures, the best types of experiments are not actually field experiments, but natural experiments. Think about something like legalization of marijuana. It would be very, very difficult to do an RCT looking at legalization of marijuana. But different states are implementing, just because the voters are voting on it, they're implementing legalization at different times. And we can look at things like, we can look at addiction rates, delinquency, and so on to try to get a sense. And I think when it comes to disclosures and other types of changes at the SEC, a lot of attention should be put into thinking about how to roll out implementation in a way that will make natural experiments possible. Evidence is great, obviously, especially when it's compared to the alternative. I think Anthony Downs said something like that about democracy. Actually, he said democracy is the worst system until compared to the alternatives. Data is great, but it's very important to think carefully about how to design the studies, obviously, and what you learn from them. And I think it's really important to try to avoid the kind of what I'd call the drunk under the lamppost effect, which is to look at the things that are easy to do as opposed to the things that are important to do. Second, it's very important to think about when you're implementing policies, to implement policies with an eye towards evaluating them. And staggered introduction is a really good way to do that. And finally, I would say, and this kind of reflects what I found with the warfarin studies, that past results are not necessarily an indication of future results.
Thanks so much, George. Thanks to the other panelists as well. Could you pass the clicker back down here for a minute? We have a few questions, and I'll ask a few questions of the panelists as well. But I wanted to do something a little bit more interactive this time for the Q&A for our previous panelists, and we have some mics for those people if they have things to chime in on. I want you to think a little bit back here on Michael's slide, which is, this is the US summary perspective, the fee table. So I want you guys to think of this in the context of a lot of the comments you guys made earlier today, right? You know, does this meet the test of any of the things that Rick, I'm looking at Rick Larrick right now, but does that meet the test of the things that you've made and others? So I'll give you just a second to think about that, but I kind of want to make this a little bit more interactive in the way we think about it. When I mentioned, just to clarify, when I mentioned earlier, you know, what if I were paying 2% or 2.5% on a fund, or what if Aunt Millie was. It's not really to highlight the difference between dollar and percent disclosure, but to highlight the issue of comparison shopping, right? So on this fee table, which I think it's gotten to the wrong one, correct? That's the fee table. So the relevant issue is, if I'm shopping around on the basis of fees, is what's the fee that I'm paying in the distribution of other fees that I could be paying on kind of a similar product, right? That's how I would make a comparison shopping. But the fee table doesn't tell me much about that, does it?
It doesn't directly compare you to another fund. I think the idea is that it's presented in a standardized order, and so it allows you, to the extent you have the motivation, to pull up another fee table and compare it. I think also this one, it gets in kind of, you're not too concerned about the dollar amount, but there's an expense example after it. The other thing I'll mention is that this information is filed in an interactive data format. So the idea is that it's a way for us to leverage private resources, people like Morningstars of the world, that are able to kind of take this information, repackage it in a manner that's tailored to investors. But to your point, as to whether it shows expenses of other funds directly in that document, it does not.
Brian, if I can jump in. So I do think the shortcomings of this table is it does require you having a bunch of other tables next to it to really be able to make sense of where the numbers are. So then having something more like the scale on the EPA label for gasoline, for the greenhouse gases, kind of places where this one product is in the space of possible products, that would be useful. I think the other is, and it's really interesting to hear this, that some people think higher fees must mean a better product, and they're actually going in the wrong direction with the sign of it. So it's a judgment call, and I don't know how the constituencies who are selling these products would feel about it, but if you make it clear that high is bad, you can have all the comparative information and this kind of relative better and good all represented within one document. And it gets around the valuability stuff that George and many others have worked on over the years.
Does anybody else on the panel want to comment on the structure of something like this, the fee table? Or anybody from our previous panelists?
Brian? Yep. One thing, and I came up with this, I was actually paying attention, but maybe I wasn't, but after some of the discussions, I'm not sure people, I think you're right. If they think high cost is essentially a good thing as opposed to a bad thing. So we were talking about what kind of graphs could you show. So I came up with an example with difference between, say, a 1% and a 2% expense ratio. And I did, so a 9% net return, 9.5, and a 10. And the difference, if you were investing $10,000 a year over 43 years, is the difference between $4.4 million and $5.9 million. And the reality is that's real, because expenses come off dollar for dollar or percentage per percentage from a compounding perspective. So that starts to, talk about how it's going to impact them over the long term, you know, from a wealth perspective, maybe that sort of sends the message a little bit deeper.
Sure. And there is basically a version of that in the fee table as well.
There's something closer to that in the shareholder report, where you see kind of a line chart that shows kind of it makes certain assumptions and shows the cost over time based on those assumptions.
Yeah, my concern is do they actually read the shareholder report, which probably, I mean, the reality is they probably don't.
I'm going to turn over to John Turner for a second, but I just want to say, you know, one of the other things that I think we can think of in terms of is sort of stylized facts for the investor. And for me, this notion that we're highlighting here, the notion that some people might have the perception that more is better, right? You get what you pay for, right? That's another part of the contextualization that sort of Aunt Millie doesn't necessarily have, right? She doesn't necessarily have that contextualization as far as, okay, what should I be doing, right? If you go kind of and ask a bunch of people even professional regulars, you might get a lot of things that investors shouldn't be doing, but what ultimately should they be doing? And do those stylized facts mean, well, no, you actually don't get what you pay for? You know, again, things like the warning label, I mean, I think there are multiple interpretations of the warning label statistically. If you believe in the law of one price, I mean, maybe you believe that you are getting what you pay for, right? If the law of one price is functioning, then if, you know, two index funds are doing something different, well, you might be thinking that there's a market mechanism that's actually creating that to happen. So there are these misperceptions that might be out there. I just want to give John a second.
To me, this has a very easily correctable flaw. It says the following table describes the fees and expenses you may pay. And as I said earlier, if you take it literally, it doesn't tell you anything because you don't know what is the likelihood you will actually pay that. Maybe you'll pay more, maybe you'll pay less. You have no context to know why it would be different from what it is. And all of us don't view it that way. But I think an unsophisticated person not used to reading these would say, well, this doesn't tell me anything. And that could easily be corrected by just taking out the word may.
One of the challenges there is a literal matter is not all these, and there are probably ways to address it, but that introductory language applies to the whole fee table. And so when you see fee tables such as this one, you'll see different classes of shares. And so depending on whether you invest in one class versus another, you may not necessarily pay the same fees. So if you're you may invest in a class that has a front-end sales load, but no back-end sales load. In that case, you know, the disclosure, the word may is probably accurate because you don't pay the back-end sales load, but another shareholder in a different class might pay that load. So it's not to say that that's not solvable, but that's as far as the little words on the page, that's kind of one, I think, reason why the word may is there.
I mean, there probably are a few situations in which it does make sense to pay a higher fee. Like an example we talk about after lunch is like an international fund. It's more expensive to administer. It's going to have a higher fee. And so what we really want to do is we don't want to just always steer people to lower fees. Like you see this in the charity realm. People hate charities that have like a high administrative cost, but sometimes that a charity with no administrative cost, that would be a disastrous charity. So what we really want to do is if we just completely steered people away from fees, it's probably going to produce its own distortions. What we really want to do is to only encourage people to pay fees from which they get something, and that's very, very difficult. Maybe it's a case where the best is the enemy of the good, that it's the best thing is just to scare people away from fees because there are too few situations where higher fees are actually beneficial. But in any case, it seems like a difficult problem to me.
One other quick thought on expansion from earlier. One problem with the percentage is 1% sounds small to everybody because it normally is in life. Anywhere else you would use it, but it's huge here. And partly it's because it's scaled against the 8% average return, and then it's compounded. And so just in terms of the expansion principle, this number just looks like 0 to people, and it always looks good. And so there's got to be a way to rescale it, and your suggestion for expanding it over time and compounding helps make it look big again. Yep.
Just to build on that, in addition to one looking like it's small, some people are going to get confused by any decimal point. Some people won't know with percentages whether larger percentages are better than smaller ones. So this is, with some people, a certain percentage of the population, they're going to be very confused by any of these percent values. So maybe something more like what Canada does, where they have the scale, or something visual, like Rick was talking about, would be better than having these numbers.
This is not a well thought out comment, but on the scaling, So 1%, of course, is 1% of your assets under management. It gets, I mean, not assets under management, your investment, right? It gets dwarfed, or it's smaller than, say, your expected 8 or 9% or 7% or 6, whatever. It is also gets lost in the volatility. In a way, the right thing to scale it against is the risk-free rate, because you're paying the 1% for sure. And so there's a question of how much of the value of your money, the risk-free value of your money, are you giving for this investment? Of course, today, it's going to look like you're paying way too much, but you probably are.
This is one from our audience, for George. How would interactive disclosures be regulated? Would the complexity make rule creation and enforcement difficult?
I think some of the same rules as apply to other types of disclosures would have to apply to interactive disclosures. So I think they need to be made, they need to be designed by advocates for the people who are going to use them, and they should be made pretty uniform. Like so, there should be one agreed upon type of disclosure for a specific type of product, so that different providers don't start competing over obfuscating the interactive disclosure. Let me emphasize again, though, that just simplifying disclosure is not enough, because if the product itself is complicated and you simplify the disclosure, you're just, you are just sweeping the complexity under the rug. In my view, the simplified disclosure has to be accompanied by product simplification.
Okay, I've gotten the curtain call. So I just want to start to wrap up and again, thank all the panelists who are on stage now and in the audience. Once again, most of them were shanghaied into this operation. I wanted to thank Frankie in particular for helping to put this together, the other people in my office, Morgan and other colleagues that have really helped to put this event together. I want to also mention some of our colleagues in the Division of Investment Management. In addition to Michael, Amy Miller, Michael Kolosov, Parisa, wanted to mention all of them, and also our procurement people. I'd also like to note Angela and Mark from NORC, who helped out with a lot of things as well. So thanks everybody for joining in today. We're really happy to have everybody. Thanks to the 2,000 people that tuned in through the website. And thanks a lot. The panelists will be around for a little bit longer too to speak.
That's all right. That's all right.
That's our stuff back. We had some slide difficulties and other things.
Yeah, that's fine.
But yeah, thanks for everybody. Oh, sure. Yeah.
It's real.
Yeah. You know, I mean, we'll be doing some survey experiments, a lot of survey, since it makes it faster for us to deploy, and we actually, with our panel, our panel will be deploying, at least initially, as Amara speaks. So it's a naturally representative probability-based panel that we can deploy and run. Hopefully it's salivating, not the lobotomy tool.